happen. It is being recorded. This will be posted to our YouTube channel, and it will be available through the Nevada SBDC if you guys want a copy of the recording. We also share the slides with them as well, so feel free to follow up with them if you need any of that remaining information. This is a lot of information in just one short hour of time. So I understand if you need to see these slides again because there's quite a bit of text on there. I won't necessarily read all of it, but I try to give you as much information as we possibly can, especially when we're talking about financials. You will notice a very large QR code on this front screen. I will share it again at the last screen as well. So if you miss it here at the beginning as we go along and talk, there is a reason that it is there. So you are actually here today, whether you know that or not, because this is part of the SSBCI program, which is the State Small Business Credit Initiative. That is the funding source of this, which is the Department of Treasury. We're going to talk about what all that means as quickly as possible. But the SSBCI program does have a technical assistance program that's associated with it, which provides workshops such as this, as well as one-on-one consulting. If you were to follow that QR code, it's going to take you to a page for the Nevada SBDC where there is a registration form, and that is how you sign up for the one-on-one consulting for SSBCI. Again, we'll talk about that a little bit more as we go on, but we'll try to give you as much information from a financial basics standpoint, as that is the reason that you guys are all here. But that is the path in order for you to get additional assistance once the workshop is over. So if you need help with that extra understanding how to put some of these things together, or maybe develop some of these tools that we're talking about. So I said my name is Christy Dudgeon. This is me again. I am the president of SBC Consulting. We are a technical assistance provider. We are assisting the Nevada SBDC with both workshops, such as today, as well as that one-on-one consulting. There is a team of us. We are mostly entrepreneurs, small business owners. We are also small business consultants. Some of us do this full-time, some of us do this part-time because we're also running businesses as well. Basically, what I mean by that, we live in it every single day, right? From a small business perspective, we probably have made a lot of mistakes throughout our careers and our lives, and we try to help you get on the right path and make sure that you maybe don't make some of the mistakes that we did. We also work with over 6,000 businesses now across the country, which means we have a lot of bandwidth as far as what we've seen and heard. And so it's not industry specific, it's all small business specific. You can follow me on LinkedIn if you would like. My at Christy Dudgeon there, as well as SBC Consulting. We do put on workshops for more than just Nevada SSBCI, so we post those on LinkedIn. You are welcome to join in any of those that are public. There are quite a few of them that allow you to join as well. And so there are topics well beyond financial, legal, and accounting, which we're going to talk about today. We also have marketing, legal, credit, how to start a business, how to exit a business, everything in between, right, is some of the workshops that we have. That is us and a little bit about me. So what are we covering today? Sorry, that got a little jumbled in my download, but we are talking about bookkeeping basics, what it means to be a bookkeeper. There is a simple 4-step process. It can be complicated, right, to be a bookkeeper, but the most important part is to cover at least those 4 steps. If you miss one of those steps, then you probably are going to have inaccurate reports, which wouldn't be the best from a bookkeeping standpoint. Also, business versus personal finances, very big in small business. When our owners and ourselves are so intertwined into our businesses, we tend to have trouble separating ourselves from our business. That can both be our time as well as our money. The 3 key financial reports that we need to look at, that's our profit and loss, balance sheet, and cash flow. We're going to talk about that, as well as cash flow basics and roughly what it means to see our cash flow from a 30-day planning standpoint. Budgeting for operations and growth, as well as funding readiness basics, what lenders are looking for, and then more information on that free one-on-one technical assistance, where we can assist you through the SSBCI program. Now, this is a huge list, and we have 1 hour. We're already 7 minutes in, so we are going to move fast. We're also going to talk very high level on all of this stuff. So quick chat check-in. What stage is your business in? You guys can just drop that in the chat and let us know if you are pre-venture. So you're kind of in the concept stage right now. You haven't really started the business yet. You're just testing out the water. If you are a startup, which means you're just now in the organization phase, or C, you're in growth. You've already got things set up and now you're moving along. If you are outside of the state of Nevada for some reason, also you might want to drop that in there. I think everybody should be from the state of Nevada, but if you jumped in here somehow, this is specifically the assistance that we're sharing is from that state. There are other programs in surrounding states, so if you somehow made it in here, just reach out to us afterwards and we can try to match you up with the correct state that you might be in. We have that occasionally. So let's talk about that bookkeeping basics. So from the most elementary standpoint of what bookkeeping is, even if you don't understand what you're doing here at the beginning, the reason that it is so important is that this is how we can generate that financial data so that we can have the very basic understanding of what our finances look like. Now, either this is we are doing it ourselves as a small business owner. Surprise, you started a business and you suddenly learned you get to be a bookkeeper, right? As well as the marketing person, the operations manager, everything else that comes along with it. However, even if you are not your bookkeeper and you decide that you're going to get rid of that, you do need to have a understanding of what goes into the actual bookkeeping so that you can jump to step 4, which is highly critical for business owners to be able to review and understand their reports. Now, you notice there are 3 very important steps prior to that in order to have accurate reports. And this is kind of where all the problems happen are in these first 3. Number 1 being the chart of accounts. We have to establish a very simple chart of accounts and we have to keep it simple and we have to be able to understand it. Second, we need to categorize all of our transactions accurately, which means we basically take every transaction that we have and we drop it in the correct bucket, the bucket being the account that's in the chart of accounts. Then we need to reconcile monthly, which means we are matching up our values to our bank statements. And then we need to review our reports. So financially, we're going to talk about reports today as well. But we are first going to speed through those first 3 things. So what is our chart of accounts? This is step 1. You only need to know 5 things. You need to know a lot more than that, but I like to simplify it as much as possible. You need to know the main 5 things that go into your chart of accounts. And this is key to also understanding 2 of those major financial reports that we're going to talk about as well. Do not overcomplicate this. If you use a system like QuickBooks, it will happily overcomplicate that for you right off the bat. There are ways that you can clean that up and fix some things, but you want to keep your chart of accounts as small as possible and keep it very simple. You'll hear me say that many, many times. So what do I mean by the chart of accounts and those 5 accounts, those 5 things that we need to know? In bookkeeping, it's a broad term. It doesn't just mean a bank account or a credit card account. It really corresponds to like that bucket that I referred to. A lot of people tend to be able to visualize that a little bit better. It's one of 5 accounts. It's going to be an asset, a liability, equity, income, or an expense. They're all 5 listed right there. And there can be multiple accounts then within each account type. And that really is what I mean by things get overcomplicated as we start to have a ton of asset accounts in there that maybe we don't need, a ton of liabilities. Really where we overcomplicate things tends to be in our income and our expenses. We think we need to record what everything was for when the money was coming in. And then also the expenses. We could have account on top of an account. And really at the end, you're just like, I don't remember if I put that in this account or that account. So we don't want them to be vague. We want them to be very distinct what they are. And if there's ever a time where we go, well, it could be this or it could be that, that means we probably have 2 accounts that we don't need both of them. We probably only needed 1. The simpler you can make this, the better, because guess what? You get to do this every single day as long as you are the bookkeeper for your company, right? You're constantly going to be taking all of those transactions and throwing them in one of those buckets. So what is an asset then? These are things that the business owns and they have a value. So this is something we can actually touch, see, understand. Even though we have, maybe we have trades, patents, trademarks, things like that. Can't really see them. We just know they exist. But they do have a value. So all of those types of things are assets. So these are going to be our bank accounts, our accounts receivable, equipment, property, right? These have a substantial value. Liability, these are things that we owe and they also have a value. So these are loans that the business may have. These are credit cards, accounts payable. These are our bills. So that's what accounts payable is. And then equity. Equity is considered to be the value of the business to the owner. This is also how most owners pay themselves, whether you know that or not, and how you would accurately account for business and personal transactions. So money coming into the business from our personal accounts, money going out of the business to our personal accounts. This is how we draw that line distinctly between what is business and what is personal. And we keep ourselves separated from that. We do that for a couple reasons. One, we don't want to open ourselves up to tax audit on the personal side because we've got things intertwined. It's actually called commingling is the term for it. Plus, we don't want to open ourselves up to liability. So we are actually based in the state of Ohio. We tend to be a highly litigious state here. People like to sue each other for every reason under the sun. We don't want to open ourselves up to any kind of personal liability. That's why we set up those business structures in the first place. However, even if we're an LLC, limited liability, right? If we have our personal money kind of intertwined in there, suddenly they say, well, there's not much separation between your business and yourself. Let's go get your house. So very important reasons to keep those personal and business finances separate. Income, this is the money in that our business receives in exchange for providing those labors, goods, services, products, whatever it may be. This is the things that we sell. What is it that we do? What do we sell? How do we earn money? Expenses. There are two different types of expenses, and it's important that we separate those and that we understand the difference between those two. They're considered to be direct expenses and indirect expenses. And the difference between those two is that direct really means that expense was a result of something that earned us money. Sometimes that can be a little confusing. However, look at it like this. We bought a product and we sold it. That's probably the easiest way to look at it. Maybe we're manufacturing and we've got a couple raw goods or materials that we had to buy to create something. All of those are direct, right? There's direct labor that might be involved. My background is very much in the grounds management, landscaping world. Anybody that was out there working on a job site that was earning money in construction, right? That labor is right there. It's producing that outcome. It's making that money. That's considered to be a direct expense. Any of those materials that you might have purchased for that project. If you are a e-commerce type company and you're shipping products to someone, the shipping to the end user could be considered direct because you wouldn't have had that expense otherwise. That's the difference between direct and indirect. Indirect pretty much means I had to pay this regardless because I just have a business. So I might not have sold anything yet, but you're incurring different expenses day to day, right? So these are things like rent, office supplies, advertising, different utilities. We're going to pay for that regardless if we sell something or not. If you're ever unsure about what these are, this is why you need to have a financial professional that you potentially are working with, either bookkeeper or accountant, that you could at least ask these questions. This is also something we can assist you with as part of the SSBCI program if you're ever unsure how to set these things up. So I mentioned do not mix personal and business. Can't talk about that enough. It's called commingling. Your business book should only track business. You shouldn't have anything listed in there that actually says the word personal. This is one of my beefs with QuickBooks. Love the software, teach it all the time. Do not like the fact that when it sets up a standard chart of accounts, you'll see little things tagged in there under equity that say personal healthcare, personal taxes, these types of things. Anytime you use that word personal sends up red flags to me all over the place. I was taught very, very early on in my very first business by a consultant that you never, never, never have anything that says the word personal or any type of personal expenses in there. So I try to convey that. So we want to make sure that we're only using things like owner's investment or partnership investment, depending on what type of company that we have, or even shareholders investment. Those are equity type accounts that are showing money that we have put into our business. And then we'll have phrases like owner's draw or owner's pay in personal or partnership draws. And that is when we take money out of the business and then we pay ourselves. That's the appropriate way to do it, is to use those two equity accounts that we can clearly show that paper trail or that flow of the money coming in and the money going out. We do not directly take money out of our business account and pay our personal credit card or pay our car payment. If we do that, then we call it equity and we call it an owner's draw. We don't actually say it was our car payment because the business does not care what you do with the money after you've given it to yourself. You're the owner. That is what you get to do. Owner's contribution investment, that's another, contribution is a word. So this is if we have a business expense that we paid from our personal funds. We do that all the time, sometimes accidentally, sometimes on purpose, right? And we want to make sure that if we are spending those personal funds for business expenses, that we are also appropriately accounting for those. One, to say that we invested the money. I see your hand, Karen, just a second. One, that we invested the money, and two, that we then apply it to the correct business expense. So did we buy a piece of equipment? Did we buy office supplies? Things like that. Same with the owner draw, right? So this is a personal expense that we might have accidentally paid from business funds. I hear that all the time. Oops, credit cards look exactly the same. I used the wrong one. Okay, that's fine. We just need to call it an owner's draw, not a business type expense. Go ahead, Karen. If you can unmute yourself. I'm sorry. I don't know why it won't let you do that.
There you go. I couldn't do it myself. Okay. We do have a few questions that are coming in that are really good for this topic. So do you want to kind of go through? The first one is there a way to calculate the value to the owner? How do they do that? I think that it has something to do with one of the reports we're going to talk about, but go ahead.
Yeah, but it's actually much more intense than just the reports. So when you're actually valuing a company, there's a lot of formulas that go into play with that. And so I would recommend that you join one of the workshops or look up a workshop about exit planning and what that might look at. It's pretty intense. It's not actually being able to look at the balance sheet or equity and actually develop that number. So it's its own topic. Let's just put it that way.
And then Michael asked, what if it is a business vehicle? I think he was referring to the way things are being paid at that time.
Yes. So if it's a business vehicle and you've purchased it as part of the business, it's going to be called an asset because it is a business vehicle. And then obviously any expenses that go into that vehicle, so fuel, registrations, taxes, whatever that may be, are a business expense. If you're using your personal vehicle for business use, again, from an accountant standpoint, I would definitely ask them their advice on that. But you have a couple options. If it's used predominantly for business, they may tell you to keep track of all the expenses that the business incurred because of that. They also are probably going to tell you to keep a mileage log because at the end of your taxes between personal and business, there might be tax advantages to having it on your personal taxes from a mileage deduction standpoint as opposed to a business. So that's important to have that question with an accountant when you're using a personal vehicle.
Okay, and then the last one on this round here is, in general, are fees considered as an expense? And I don't know what fees we're referring to, but it could be a variety. But any thought on
Yeah,
that?
as long as it's related to the business. There are some fees that you would have that are specifically because of a sale. I can use an example of like a service-based company. I know I work with an HVAC company that has to buy permits all the time in order to be able to install the HVAC equipment. So that's a direct cost from their standpoint. They obviously wouldn't have those permits unless they were working on that specific job. Bank fees, as well as, there's other fees right out there that we happily get to pay all the time, that might just be an indirect expense, but they typically would be some kind of expense.
Okay,
All
you
right,
can go from there.
keep moving on.
Yep.
Yep. So important reminders again, keep that owner's pay separate from business expenses. So what I mean by this is LLC, sole proprietor, partnership, we typically want to pay ourselves as a business owner, right? And we're sometimes not sure how we can do that because we might try to add that little line item in our chart of accounts that says salaries, maybe wages. Well, as the business owner, technically we are not an expense. It doesn't affect our profitability. Now, we could be a W-2 employee, and that's going to look a little bit different on our profit and loss and in our chart of accounts. But if we're just writing ourselves a check, again, if we're sole proprietor partnership LLC, we can do this in those three. We want to make sure that we are calling that an owner's draw or owner's paid in personal in equity and not calling it a business expense. So the question that we had about business valuation and how we value the business, this is a very important differentiation when we are valuing a business. We do not want the owner's pay to be considered to be an expense. We do want that to be an equity. So if we can get in the habit of doing that in the beginning, the better off we are. Do not categorize personal spending as a business expense ever, ever, ever. Mark it, clean it up, get it off those reports. Change any name. Don't have an account that says anything about it being personal. Clean categories equal accurate reports, and that also is better funding readiness, right? We don't want to go to a bank and have these kind of things on our reports either. Keep that chart of accounts simple. So this is a very basic example of a chart of accounts. You can Google these, you can ask AI, they'll give you very simple ones as well. Usually even the ones that I see for I'll chop them up even in Google and take out other things as well. So you want to make sure that they're very clear, very easy to recognize and understand. And here, so we've got our checking account, we've got a credit card. We may have more accounts than this, right? We may have a savings account. We might have a loan that's also a liability. Definitely we need those owner's draw, owner investment. This is single owner assumption here. Income, sales, we can all start with just one income or sales line. Sometimes we do things that are so distinctly different. What I talk about in the contracting world, we might want to differentiate commercial income from residential income, right? If we're working in kind of both those worlds, those are two distinctly different types of incomes. I've seen people start to put products in here, and if you can imagine how your company would grow, you might have 5,000 products, right? Or 50,000. You do not want to set up a profit and loss that way. There are other ways to be able to detail that out. Cost of goods sold, that's that direct expense that I talked about. There are different cost of goods sold that you could differentiate, such as materials, such as labor, if you have contractors that work for you, that type of thing. And then everything from under cost of goods sold, those are all our indirect expenses that are pretty standard, right? And your business may not need all of them. You may need more than this, though, right? And so that's specific to your business. But this is the most simple form of a chart of accounts that you could possibly find. If you need inspiration on a chart of accounts, though, and you're setting it up for the first time, go travel to the irs.gov website and find a Schedule C. So if you are a sole proprietor partnership LLC, you are going to file a Schedule C every single year with your taxes, and it is the most basic form, again, of what that income and expenses will look like. You'll actually see sales or revenue income on there. You'll see cost of goods sold, and they'll actually ask you to break that out, as well as very basic expense accounts then from those overhead or indirect accounts. So step 2, then, we need to categorize. So we've got our chart of accounts set up. We just now had the crash course and what all of those terms are within our chart of accounts. And so then we categorize all of these transactions that are happening every single day. We want to be consistent. So even if we are consistently wrong, we're still being consistent. And the reason that I say that is on the other side, when someone's helping guide you, helping clean things up, helping merge accounts or whatever that may be, it's a lot easier for you and a lot cheaper in the long run to do that cleanup if you've at least got your consistently wrong things all in the wrong place. So maybe it's something like a bank fee, right? And we weren't sure and we called it something else. And then you're talking to a consultant, they say, oh, well, that's a bank fee and that's a bank fee. And so we just all lump them together. Well, if we can just take all those groups, right, instead of having a little bit over here and a little bit over there, then it's better. And it is awkward at the beginning to do this categorization when you're not really sure if you're doing it right. I say use your intuition here. Always ask a professional if you can. Categorize what it was for, not by the vendor. We see this mistake a lot because of Amazon. Amazon can be a lot of different things, and someone will actually create an account called Amazon and then just throw everything in Amazon. Well, Amazon could actually be parts, which could be a direct cost, could be that cost of goods sold. It could be office supplies. Amazon could just about be anything, right? We could have bought groceries for ourselves, from Amazon. So we want to make sure that we are correctly splitting those up into the expenses that they are and not just calling it an Amazon expense account. Your accountant would flag that probably at the end of the year when you go do your taxes. Regardless, use business accounts for business spending only. There's that flag again. Do not use it for personal. Keep the owner pay separate from business expense. Said that before. Record transfers as transfers. So this is a software thing as well, that sometimes can happen where a transfer doesn't actually match or pair to itself. However, this can happen even if you're doing this on paper, right? So we take money out of our savings account and we put it into our checking account. Don't call that income accidentally, right? That's just a transfer of money. That's not an expense either. And there can be a lot of inaccuracies that happen between transfers. Payment processors, another big one. We're all moving into using electronic money all the time, right? Very few cash and checks happening. Payment processors typically on a daily basis, it depends on the payment processor, drops a deposit into your checking account. Well, that deposit happens to be a lot of things that are happening in there. It generally can involve sales tax. There might be refunds in there. There might be the sales itself in there. And then they also have fees that were taken out, right? So that deposit isn't necessarily income. There's a lot of things that are in there, and we need to appropriately account for what those items are as well. Add notes to unusual transactions. This will help you in the future. So if there's something that you weren't sure about in the first place and you are still questioning yourself after the fact, or maybe it's just something weird, there's always memo lines when you're using something like QuickBooks, or even if it's on a piece of paper, right? That write yourself a note, because inevitably it's going to come up again and you're going to sit there and question yourself and wonder what in the world that was for. If there was a check that was written to somebody that is out of the blue or something like that, having those notes there are super helpful to make sure that you can help yourself in the future then. And then review uncategorized items monthly and resolve them. So the reason I mention this, if you're using something like QuickBooks, there is a uncategorized or miscellaneous that you can sometimes utilize. Don't just throw everything in there. Even though it lets you, you do have to actually define that at the end to make sure it goes into the correct bucket. So if for some reason you've got a bunch of things in uncategorized, you can go through that, look at all of them, and then move them to the appropriate expense accounts. And you'll notice something like that when you look at your reports, which is going to be step 4. Common mistakes when you're making loan payments or credit card payments, those aren't expenses. The expense itself from a credit card is what you bought when you spent the money, when you swipe the card. The act of paying that card is actually going back towards the liability. So I often see people that will add a account to their expenses that will say mortgage payment. This is a real estate thing. Mortgage payment, nope, got to pay that to the liability. Or we'll see credit card payment, but we don't actually know what all those expenses were for that credit card. So we've got to take every single one of those and break those up. Transfers between accounts, I mentioned that. Owner's draw, personal spending from business accounts, mentioned that before. Deposits that are not sales, these could be loans, right? So if we get a distribution of funds for a loan, that we want to make sure we don't call that income, right? That's actually opening up that liability or that loan account. And we want to call that appropriately. We definitely don't want to pay taxes on a loan that we're receiving. Same thing from owner's contributions, right? We don't want to say what the money we put into an account to be income and pay taxes on that as well. So we want to make sure that those owner contributions are called those owner's investments or contributions, as well as refunds. So if somebody bought something, right, and we have to return it or refund it, we want to make sure that we're accounting for the fact that we refunded it. Same thing with expenses. So maybe we did buy something from Amazon and then we returned it, right? We need to make sure that that return is going back against that expense so that we're basically clearing it back out of the account that it's in. Sales tax collected, those payment processor deposits. I mentioned kind of all the things that can go wrong with those payment processors. Sales tax often gets called income. We see it all the time. We've got a deposit that goes in there. We definitely don't want to be paying tax on tax that we're just collecting. Sales tax is actually considered a liability. Same thing with payroll withholding. So if we have W-2 employees, those withholdings are a liability until we've actually paid them to whomever we're going to pay them to. Now, with sales tax, we don't ever get to call that an expense. We are just holding sales tax to pay it back to the government. So it literally is just going into that liability withholding account, and then we're paying it back out. Equipment recorded as supplies. So equipment sometimes can be an expense, but it also can sometimes be a fixed asset. And this typically has to do with the value of that piece of equipment. Again, this is an accountant question. Some accountants will tell you if it's over $1,000. Other accountants will tell you it's over $2,500. It may be $5,000. It depends on your account. So we want to make sure that we're appropriately calling those either an asset or an expense. And the reason that we want to do that, if you're not familiar with what an asset is that if we are a business and we buy an asset, which is a really expensive something, right? Somebody mentioned a vehicle earlier. So a vehicle almost always is an asset, usually because it's over a certain value. We get to do something which is called depreciation. And so what that means is instead of us taking a $10,000 expense deduction all in 1 year, which is what it would be if we called it an expense account, we get to take that $10,000 over a number of years based on the usable life of that vehicle. So again, that's why we ask an accountant these questions. And that we also don't suddenly drop our profitability, right, and have this huge loss because we bought one piece of equipment, and we can take that expense then over time. Business versus personal meals. This is a touchy one with the IRS. There is 100% deductions with meals. There's 50% deductions. It depends on who you were with and what you were doing at the time. We want to make sure that we have those appropriately broken up. It's not just every time we go to the restaurant, even when we're during business hours, right? There are some specific criteria that we need to make sure that we're accounting for in that. And so we might actually have two meals lines depending on what type of business that you run and kind of how you operate. And then vehicle costs, that vehicle question again. So whether it's a personal vehicle or a business vehicle, and how we are actually tracking those expenses, we might be tracking them on the personal side versus the business side. So those are common mistakes that we'll see with that as well. And then one-off special transactions, I mentioned those fixed assets, new loans or lines of credit. We have to put those in our financials, right? Because those are liabilities, and we need to make sure that we have the balances on those correct, as well as keeping those correct. So every time we make a payment, it needs to go to the loan. Every time we're charged interest, we need to make sure that we're putting that in there. Grants or program funding. This is a big question that happens if you're lucky enough to receive a grant. It may not be considered income. It may be considered other income. Some grants are taxable, some are untaxable. So we need to make sure that we just appropriately have those accounted for in our books as well. Refunds, chargebacks, reimbursements, I mentioned that. And then major repairs or replacements can sometimes be considered assets as well, as opposed to an expense. So quick check-in of all those things I just said. What are you the most confused by? Loan payments, how do you handle those? Credit card payments, owner's pay, payments to processor deposits, or all of the above. Feel free to be honest here. No judgment. These are all the hardest parts, I would say, of bookkeeping and what to do with them. Unfortunately, with payment processor, I saw that one right off the bat. The connectors in software are not always the easiest to understand as well, and there is some management that is involved with that. So now that we have our chart of accounts set, it's simple, it's awesome, we understand it, we know what accounts are there, it's clean. Then we start putting everything every month into those buckets. So we're categorizing everything. The third step that we have to do is we have to reconcile our accounts. So reconciling monthly is the best thing to do here, because often we receive statements every single month. Not just for our bank accounts, but our credit card accounts will also receive, likely for any loans that we have, we'll be able to see that every single month. So this is the process of confirming the value of our accounts are correct. So it is possible for us to even have a connector into something like QuickBooks where we've got all the bank transactions feeding in. We categorize everything. It's still possible to have duplicates or missing transactions in there. And so the only way that we're going to know that we have duplicated or missing transactions is by doing this process that's called reconciling. And so we are catching all those as well as any transfer errors that might have happened, right? So maybe we didn't catch that it also happened on the savings account side. So we've got the checking to savings and then we've got the savings to checking and it's the exact same transaction, right? And so that duplicated. There are bank errors that happen. They are few and far between, but trust me, I've seen it. Checks that didn't actually go in that people thought were, maybe they charged your account and they shouldn't have. Maybe there was something missing altogether. Also, with bank feeds, they are live, they are electronic, they get broken all the time with things like QuickBooks because that's a security measure. And sometimes glitches do happen and transactions just did not feed in. We will be able to catch and see all that with reconciling now. So we're not only confirming that everything actually is there, but we are also reconciling from a standpoint of removing anything that doesn't belong or that was duplicated. So we have to do both. So the last thing we want is for any account to be overstated, right? So we've got extra money or extra expenses or extra income, right, that doesn't really exist. Because it was a duplicated or potentially understated. So we have expenses that we're missing that we didn't catch because we weren't doing reconciling. So reconciling it can be a fairly simple process, especially if you're using software to help do this. Otherwise, it's literally looking at one and looking at the other and doing a lot of crossing off, right? So it can be kind of daunting if you're not having that software help you. Then we review reports. So the big thing that we're trying to get to by doing all of that work that we do on the front end. So once the transactions are categorized and the accounts are reconciled, this is where we as business owners can say, okay, to our best of our ability, or at least the best of our knowledge right now, it is accurate. This is the most accurate point. Now, you can have somebody else review this, right? They may say that it's not, but at least at this point, you know you've done everything that you needed to do to get to this point. So when we review our reports, then we are making sure that they can tell us the correct story. So unless we've done these processes up until this point, we have very little confidence in what those reports are actually telling us, even if we're using financial software, right? But we're looking for things that we can understand at the beginning. The more that we do this, the more that we will start to understand things differently and be able to look at these reports and really make decisions off of them. But initially, we're just looking at the accounts that are in there and the numbers that are there. It's amazing how quick a business owner, even the very first time they look at their reports and go, oh, that income's not right. I know I did not make that much money, or nope, we didn't spend that much money on that. And you will look down and see those numbers and be like, okay, now I need to dive in there. And it's instantaneously when we work with business owners. It's pretty awesome because most of you have a pretty good handle on every single dollar that comes in and goes out of your business, especially when it's small. So major expenses, something that's unusually high or it's missing, you know that you spent money on something and it's not there. Large amounts sitting in that uncategorized or miscellaneous if you randomly have those. QuickBooks will also have an account called Ask My Accountant in there, and that's an account that you'll use when you just really have absolutely no clue on what to put that in. It's a way to talk back and forth between a bookkeeper and accountant. Obviously, before you generate this report and send it to someone like a lender, you don't want to be utilizing that account. So that's another one that you would have to go through. Owner's pay or transfers not showing up as expenses. You want to make sure they're not there, right? Loan payments don't want to be in expenses. Payment processor income and fees, you want to make sure those look right. And cash balances match what you would expect them to match. All right, and why these matter? It helps us catch those errors early, keeps our books accurate, helps us trust our numbers, which is huge, make us confident in making those business decisions, and it also makes funding readiness much easier. So once we hand these over to a loan officer, we want them to be able to review them quickly, say everything looks good, and it could go right to the underwriter, right? We don't want the loan officer to be the one that goes, oh, you probably should get someone to help you out with that. And you want to go back and have that cleaned up. So the simple habit is categorize, reconcile, review, repeat every month. You'll notice of the 4 steps, I dropped chart of accounts out of here because that's generally a first step in setting things up. You just want to make sure you're adding the appropriate accounts. If you buy something like an asset or you get a new loan, you're adding those. But once it's there, it's pretty solid and you don't really need to do much work with it. So categorize, reconcile, review, repeat every single month. All right, the 3 key financial reports that every business owner needs to know and understand are the balance sheet, the income statement, also known as the profit and loss, and the cash flow statement. I can tell you that the third one on there, almost everybody goes, what is that? I've never looked at it. You might have looked at a profit and loss and balance sheet. However, the cash flow statement is the key to you being able to flow the money in and out of your business correctly. It is very, very important. So here's just a little doodle on the financial statements. This helps us track growth. It helps us know if we're making money, helps us manage our resources when we look at these. Also, a bank might know if it's a good investment, or a VC if we're going that route. Access or assets, it's our management, as well as any red flags that may exist. So, balance sheet, what does this show us? So, remember, if we go back to the 5 things that I told you that you had to learn, you will see all 5 of those on just these 2 reports. That's why they're extremely powerful. The balance sheet holds 3 of them. Those are our assets, liabilities, and equity. And so this is what the company owes and what the company owns. This is also what belongs to the owner, right? So this is where we've got those owners' investments, as well as the owner's pay and personal. Retained earnings is another phrase that you'll see there in that equity. That is the profitability of the business over time. That's how a bank knows, hey, have you been profitable for more than 1 year, or are you always running at a loss, right? So if that number is positive or negative. This balance sheet is going to really determine financial health from a banking standpoint, and also help you obtain loans. So it's extremely important that all the values that are on this sheet are accurate, right? And almost all the values on here we can match up to a statement as well. So this is where our bank accounts are. This is where those fixed assets are. This is where our credit cards are, sales tax liabilities, loans, things of that nature. We're going to see those all in here. So when we're looking at those for the first time, we've looked at it right after we've reconciled. We can look at it, anytime we want throughout the month. We just know from a balance standpoint, it's the most accurate right when we've reconciled at the end of the month. We want to know that all those balances are accurate and if something looks out of place. I can tell you with the majority of people we work with, this is the first one they'll say, oh, that's not right. Like maybe they'll get their profit and loss right, and their income and expenses look correct, but they'll be like, I have no idea what those loan balances are or why they're doing this or that. Obviously, there's some things that need to be cleaned up in there. This report, though, will help you say, where does my business stand right now, right? From a lender standpoint, they want to know, what's your debt ratio, right? Do you have too much liability, not enough assets? How much equity has the owner actually put in and out of the business? They're going to see that from that report. The number one most utilized report, and the one that most business owners will look at from time to time, is a profit and loss report. I was in a company that I worked in. I looked at this report no less than 3 times a day, and it's because I manage the financial team as well as the operations team, and were constantly numbers changing in here, right? Not a small business at that point when we were looking at a profit and loss 3 times a day, but I was always being questioned what was happening with it. And so this is how much money your business made, how much it's spent, and whether or not you're profitable or you have a loss. You can look at this report over a period of time, which makes it really cool. You can look at it for today. You can look at it for the week, for the month, last year, the year before. You can compare, how did I do today on April 14th versus last year at April 14th, right? And you can really start to see cool things about your business and trends, especially if you're a seasonal type business. You want to look at it and say, does my income look correct? Does my major expenses make sense? Is there anything unusual or missing? What you'll know from this report is, am I making money? You'll also be able to figure out your gross margin and some other really cool numbers from that. So, have you ever been profitable in your business? If you looked at your profit and loss, you've got a great strong number there on that bottom line with profitability, but you had no money in your bank account or you were short on money. Is that a yes, no, or not sure? I can tell you from this standpoint, almost everybody says yes, right? Here we go. All the yeses. Yes. So we can have a very profitable business and have no money in the bank, and which also means we get to pay a lot of taxes at the end of the year because we've got a great profit. However, we have no money in the bank in order to do that. That is why the third and the most underutilized report in business becomes extremely important. And this is our cash flow statement. Now, in order to have a cash flow statement, we actually have to know what's coming in and what's going out in our business. If we use software, we can, this will help us. If we invoice our clients and we're not putting the invoices in the software, the cash flow statement will not be correct. If we get billed by certain vendors, which we all do, right? We all receive bills all the time, they're never ending, and we don't actually put those into our software, then our cash flow statement also won't be correct. So we really need to know how the money is moving, and looking at a snapshot of that is really the best way for us to be able to say, can I buy that thing? Can I spend that money today? When is my payroll coming up? How much is it going to cost me? So we really look at these from three different ways. This is our operating activities, our investing activities, and our financing activities. And so we know the money coming in, the money going out at the end of the day. And it's even better if we break this down by week so that we can say, can we pay our bills today or this week? Or is it better if we wait until next week? And you'll start to see a lot of businesses develop a AP plan or an AR plan, right? So depending on when people are paying us, you may pay your bills on the 15th and the 30th of every month. Some businesses only pay all their bills one time a month, right? And that happens to be a cash flow thing. So they know when the money's coming in and when the money's going out. It also saves you from having to sit down and pay bills every single day, because that's really not the best thing to do for your business. And also you need that visual. That's really what cash flow planning is all about, is getting that visual of what's coming ahead so that you can plan to be able to make those payments that you need to make. Um, if you were in a seasonal business, as I mentioned, I was in the grounds management landscaping world. It was not uncommon for us, even when I was in the commercial construction world, to be sitting on expenses for 90 days before we ever got paid, right? So it depends on who the clients are. Usually, the bigger the client, the longer it takes for them to pay you. You would think it would be the opposite, but really it's not. So that is a cash flow management standpoint. And obviously, we can use things, unfortunately, if we have to jump into credit cards to help piece things together, lines of credit, right? Those help us as well. We don't want to find ourselves in an emergency situation where we're always panicked. That is the small business world that we all want to get out of. And really, this cash flow planning is the way to do it. So, money feels tight basically means income's coming in well after the work is done, right? Bills, payroll, taxes come out before we ever got paid. One late payment can throw everything off. I do tell the story in 2008, if any of you were around for that time. Owning a commercial construction business was not a good thing in 2008. That's when the economy crashed and all commercial construction stopped. We were not getting paid by our general contractors that we worked with as we anticipated, right? So what does that mean? I can't pay my vendors. You suddenly see how the economy stops really, really fast when people can't pay each other. It trickles down. Unfortunately, the little guys are always the last ones and the first ones to lose. Money coming in, these are our expected deposits, invoices, sales, money going out. These are our bills, payroll, subscriptions, debt. Set aside for taxes, right? We have to plan when taxes are going to be paid. If we're paying quarterly taxes, definitely if we're bringing sales tax in, we need to make sure that we're not just utilizing that in our bank account like it's money that we have. That's another reason that cash flow planning is important, because sometimes we look at our bank account and say, oh, we've got all this money. Guess what? We don't. It's already allocated for all these other things. And then what's left is what helps us guide those decisions. The big part about this, as I mentioned, is it reduces those surprises. It helps us plan our expenses and it shows those problems early to give us more control. I am going to skip over budgeting, even though it's extremely important, just because we're running out of time already. So the big question here is, are you running your business or is it running you, right? And so having that bookkeeping plan in place, being able to look at those reports, being able to plan out that cash flow. When we jump into the world of budgeting, budgeting is looking back as well as looking forward. We're making comparisons. Cash flow is really the only thing that we're truly looking forward to how our money is moving. And the key to all this is so that we can be ready for funding at any time. And really, the reason that we talk about funding when we talk about finances isn't because everybody needs to go out and get a loan today, right? But if we are managing and maintaining our finances at that level all the time, we make a lot of different decisions for our business than we do if we don't understand where our finances are. So if we call ourselves financial ready, then this means we have a profit and loss statement that we can know and understand and defend, as well as a balance sheet. We have cash flow information and or projections. So maybe we're a new business, right? And we don't have all that there. We've got those cash flow projections so that we know where we're going. We also need our business tax returns. So we need to be filing business taxes. Personal tax returns are often required, so don't be surprised if you get asked for those as well. Many SBA-backed loans require personal guarantees, so you're going to be asked for your credit. You're going to be asked for your personal business taxes. Bank statements will be asked for because those support all that information that you're putting in those statements, as well as a debt schedule. So what do our liabilities look like? What are the balances on those? How much do we pay every single month? We can't always get how much do we pay every single month off of a balance sheet, right? We can know what our balances remaining are. But the debt schedule would give us a little bit more information. What is the term on that? When does it end? What is the interest rate? Business plan. What's our use of funds explanation? So that is something that will often get used asked for as well. And then there's that credit information that I mentioned. And why they are looking for this. So they want to know, can this business repay the money? So not only are you making great business decisions up to this point and can your credit support it and all that, but also can you repay it once you've borrowed the money? Do you have a consistent income? Is it positive? Is it improving? What big difference is this infusion of money going to make, right? So the last position you want to be in is, oh no, I need a loan because I have to pay bills and I can't pay them, right? That's that emergency situation. As opposed to, I want to expand my business, buy a piece of property, buy a new piece of equipment. What difference is that going to make to my business if I have this money? Am I saving on time, labor, those types of things, right? Is the business financially organized? Oh my gosh, this is huge. Guess what story it tells about you when you walk in with clean, accurate financial statements as opposed to ones that are in kind of disarray, right? It shows you as a business manager right off the bat, and they're going to make that informed or uninformed, right, decision about you. Consistent bookkeeping, very important. Clear separation of business and personal finances. Does the owner understand their numbers? So when I said you have to be able to defend it, right? That's why you're leaving yourself notes. You're able to tell the story about what is happening. You can explain your income and expenses. You know where the cash is going. You have a plan for how you're going to use that in the future. And so that's that confidence and clarity that every business owner wants and needs to have. And so, how can the SSBCI Technical Assistance Program help with all this stuff that I talked about? Again, QR code that I said that I was going to share with you. So, if you are disorganized, if you want to learn how to use financial software, if you need help putting together financial statements, or if you just need someone to look over them and say, okay, the structure is correct, and maybe I would do this or I would do that. If you don't have a business plan or you need one, you need financial projections. If you have credit issues on the personal side that maybe you need guidance on how to clean those up or fix those. These are all things, thankfully enough, that fall under the SSBCI program for technical assistance that you can ask for help with, and it will cost you nothing, which is the best thing. Right? So that's my little sales pitch about SSBCI. Use it. It is there. And they are willing to help. So the SBDC is always there to help in the first place, but now they actually have this other program on top of it called SSBCI. SSBCI does have a capital program with it, so there is a lending component to it. You do not have to be seeking capital for SSBCI in order to tap into the technical assistance that you can have from SSBCI as well. It's there for small business owners. So please register for it. If you're not sure if you qualify for it or not, it doesn't matter. They will let you know whether or not you qualify. So please just go ahead and register and get the help that your business needs. Go ahead, Karen. Questions. 4 more minutes. I told you I was going to talk fast. And you're muted. Look at that. Zoom locking you down. Okay. Let's see if it works.
All right, sorry about that. Okay, so one of the questions in there was what software systems can they use for bookkeeping? I know QuickBooks is a big one. Are there other ones out there you want to quickly go over? There's 3 questions I want to get through, or at least so.
Yeah, so there are a lot of software systems out there. It's not just QuickBooks. I just mentioned QuickBooks a lot because we teach it and it's very widely used globally, right? So Xero is another one you might have heard of. You can use something as simple as Google Sheets or an Excel document if you're very new and starting out, a piece of paper, just something, and whatever it is, be consistent with it, but have a method to use it. Sage, there you get into huge accounting systems as well. If I was a small business owner, I would want to make sure that if I'm developing a tech stack of any kind, I want things to be able to integrate with it in the future. So we talked about these POS systems, right? So if I'm choosing a bookkeeping software, I want to make sure that if I'm already using Square or if I'm using Shopify or whatever it may be, that they're going to actually connect and talk to whatever it is, because I hate manual processes and I hate duplicate data entry. I don't have enough time as a small business owner, right? And neither do you. So you want to make sure that whatever you choose is talking to each other. So if you're going through that kind of system and figuring out a bookkeeping software, that's my biggest piece of advice, especially if you're already using something else.
Okay,
Next.
Dan asked a question about how many different checking accounts do you recommend opening to balance your spending where money doesn't always come in on time and when you want it to. So is there a number of checking accounts or does one make sense on
There
that?
is no magic number here. However, there is a differing of opinion depending on whatever business book you read, right? So some will say you should have 4 checking accounts. I look at it from a bookkeeping standpoint. That means I would have to manage and reconcile 4 separate accounts. However, it is always a good idea if you run payroll of any kind to have a separate payroll account so that you can keep that out of your operating account. Also, if you're having trouble with paying your taxes because of cash flow issues, it's not always a bad idea to have a tax checking account only, right? Just keep in mind, you could open them all and they can probably all be free, right? But you have to manage them in the end and reconcile them. So really whatever makes the most sense. I know there are some people, if you are familiar with the envelope method, right? So sometimes we have like our envelopes that we do budgeting. I've seen people with 8 checking accounts because that's just the way that they can keep it straight in their minds in order to do it. So really it is a personal preference in the end. I personally like one, and then I review my reports and use cash flow as opposed to using my bank accounts for that level of detail. But that's just me.
Okay. The last question here, and we had a couple of them in here talking about cash flow problems and what you recommend to do when payments are not coming in as quickly as you think and you need to pay payroll and things like that. I mean, other than planning, is there another idea for that?
Unfortunately, no. That just means that your money coming in is not meeting your debt obligations. So you're running extremely lean, and you're kind of walking that fine line. I did mention a line of credit. There are a lot of businesses that will use a line of credit for situations like that. But that maybe your accounts receivable terms might be a little bit too far out. So, right, like you're giving people 30 days or 45 days. I do know also there are just some people that just do not pay on time, and so even the best plan can also be your demise. So that would probably be a business by business situation too, as far as evaluating kind of what your incoming money looks like as well as your expenses to try to help you not run so tight
Yep.
on that money as well. Yeah.
All right. And then one more, if you can do it in just 10 seconds here. Best resource to buy existing small businesses. Do we have a resource for that for purchasing businesses?
Finding them or understanding what is a good purchase or not a good purchase, I guess is the question.
I'm not sure because we only have a little bit here,
Yeah,
but Bennett, I think Bennett, if you're listening to us, I think this is a good one to contact through the SBDC there
yeah.
and see if they have a local resource. There are many places to buy businesses these days, so different websites and different things like that. But the SBDC is probably a good contact for that.
Yep. That also could be something within the SSBCI program if you want help
Could be.
evaluating. Yep. So lots of great resources there. Thank you everybody for joining us. Do not forget to ask the SBDC for help if you need it. Right? We are here to help. There will be more workshops coming up as well. I think we have one every single month, right, Karen, on a different topic.
Yes.
So feel free to join in on those as well. But thank you all for being here.
Have a good day.
Bye bye.